Well, good morning, everyone. Thank you so much for joining us for this in December, the end of December, for the final webinar of 2020. And we thank you for all the webinars we've done this year. This is certainly a new venture for us. I hope you've learned some things, and our plans are to continue hosting monthly webinars in 2021. Just a reminder, as we get ready to start this morning, to mute yourself. While Matt's talking, later on, we're going to open it up for questions, so you'll be able to have a conversation that way. In the meantime, if you have questions that come up as you think about them, you can just post them in the chat. We can get to those later as well. So year-end taxes, everybody's favorite topic, right? So, but this year, I think particularly, it's important to really understand all the different programs that are out there, how they've impacted, if you've taken advantage of them, what you need to do now, because, there's really some things that have to be done correctly. So we're happy to have Matt Cekander join us to talk about this topic. I'm sure most of you know Matt. He's a CPA, a partner with Doehring Winders and Company. He's been in the accounting field for over 20 years. And began his career with Doehring Winders in 2006. So with that, Matt, I'm going to turn it over to you.
Okay, thank you, Norma. Good morning, everyone. As Norma said, I'm going to go through an outline that I came up with. But as you have questions, if you want to type those into the chat or they come up, that will help it keep it somewhat interactive without jumping in. And then at about 9:30, I'm going to stop for Q&A. Doesn't mean I'm going to have all the answers, but at least give me something to get back to you with, or if there's something you want us to look into. There's a lot going on right now, and as we speak, there's developments going on with PPP, not just on the forgiveness side and the taxability of that, but also PPP2 discussions are really heating up with bipartisan support. So just on the onset, if you take nothing else away from this, be ready for what you want to do with PPP2 should that pass, because it looks like it's got pretty strong momentum right now. And at this point, if I had to make a bet, I would put it that there will be some form of PPP2. If you remember in the first round of PPP, that went, I think that was $350 billion or something. Went in like 10 days or something. So it went quick. So if that's something that your business is needing, or you hear other business owners struggling, wanting to know what to do, let them know that might be coming, so they can be ready to go. Because if that happens, I don't foresee it lasting very long, at least in the first round, depending on what comes up. But nothing official on that yet. Just a takeaway there. If you don't take away anything else, that that's could very likely be coming here. I'm going to go over a little bit on organization. Number one, record keeping. A few record keeping reminders from business owners. I'm not representing the IRS. I'm not representing Doehring Winders. I'm just representing some of the common sense things I've learned over the last 20 years in doing this. And whether I was at the firm that I was at my first 5 years up in Chicago or down here, those requirements are the same. So I feel like I have a decently broad enough hat to speak to those items. Second thing, I want to go with the current state of tax rates, federal and Illinois, just a quick overview. Then we've got some investment questions that seem to come up with year end from a business standpoint. You've got simple options, SIMPLE, the Savings Incentive Match Plan for employees. You have the SEP that doesn't get used too often for some of the smaller employers. Of course, you have 401k. You have the 401k with the Roth designation. You can blend those. We don't set those up, but we can give you ideas from a tax side of it. And I just want to make sure that people understand that, because those can be good tax planning tools. Expenses, just is there anything that you want to accelerate into 2020? The income received, and where we think some of the future of tax rates, some of what we're hearing from a corporate standpoint, and also capital gains. Okay, with that, I'm going to jump in with organization and record keeping. Bottom line, a lot of times we get questions on, can I deduct this or not? And there's an age-old phrase, is it that the IRS uses? Is it ordinary and necessary? So if it's not, if you don't, the less ordinary, the less necessary you think it may be, I'm just going to say the better your record keeping better be in your documents to support that transaction. Just good housekeeping matter. The burden of proof rests on the taxpayer. So we've seen it as far as an IRS auditor not allowing the credit card to represent proof of the business expense. They wanted to see the gas station receipt that you purchased the gas, not that gas was purchased on your credit card statement. That's pretty extreme, but I just want to throw it out there. That's IRS's stance if they want to play hardball with their documentation. So keep that. The best thing there is just keep it in good order in the throughout the year. Don't try to do this all at year end, or it will be too much. The other item to note on with the record keeping, Illinois is this isn't income tax related, but sales tax related. We are hearing that sales tax auditors are increasing in Illinois. So just a reminder, anytime you've got big ticket items, purchases, make sure you keep proof of sales tax paid somewhere in your, if it's equipment that you have around, keep it in your forever folder until the equipment is sold or leaves the building. We've had some instances where in Illinois, in this case, an Illinois agent came in and said, show me proof that you paid sales tax on this desk and the office furniture. Well, it's 10 years old. We shredded it after 7. Well, to them, nope, you got to show proof that sales and use tax was paid on that, or they could hit you with sales and use tax and penalty again on that. I'm not here to comment whether or not that's fair. You can probably guess what I believe about that. But the takeaway, good record keeping, especially on big ticket purchases, and the more quote unquote gray area you think you might be, the better documentation I recommend that you keep. Okay, and if anyone has any other questions on organization record keeping, that's all I'm going to say on that as housekeeping matters. You can throw them in the chat. The current state of tax rates, I'm going to get, I don't know what types of entities everybody has. Right now, we're still dealing with, if you're a C corporation, we have a flat rate of 21%. The future of those rates very likely could be going back up, probably not to the 34%, but 28% is what's on the table right now. Globally, the corporate rate is, it seems to be in the mid to high 20s. So I think one of the strategies of the Trump administration was to bring that down below what the global average was to shift jobs and some things here. I think that's what was going on. So I think going something above 30 might be unwise from a global standpoint, but just going to throw that out there so you kind of know what are, globally, what are people paying on tax rates on C Corps. Right now, we're at a flat 21% though. For individuals, which you may have a flow-through entity, meaning an S corporation or a partnership, or maybe a sole proprietorship. That's going to flow through to the owners at tax brackets that range from 0% to 37%. There's 7 different tax rates, actually 8 if you count the 0% for the first 10K. So that's where we're at, is 0 to 37%. The highest tax bracket kicks in around $600,000 married filing jointly. We'll get into the future rate. We don't know what it's going to be right now. There's talk of repealing the Tax Cuts and Jobs Act. Don't know if that's going to happen. If it does, it adds about 3% to all those brackets. So we've got, as another example, around 80,000 is where it goes to 22% tax bracket. The next big jump is at 300,000, 32%. Those will be 35 and 28. Those will be about 3 to 5% higher if the Tax Cuts Act from a couple of years ago is repealed. So just to let you know, current and where we might be going with that. For the purposes of the investment discussion, we get a lot of questions at year end what to do. And there's strategies of the expenses to accelerate, which is, it's hard without doing like a show of hands, who's on cash basis, who's on accrual basis, who doesn't care, who doesn't know, whatever. If you're on the cash basis of accounting, which a lot of small businesses are, and by the way, the Tax Cuts and Jobs Act actually lifted that requirement from 10 million up to 20 and 25 million and indexed it for inflation. You could elect to do the cash basis. So if you are, you can always make your payments into the year, get all your payables cleaned out, so that you can take those deductions on your 2020 return. If not, then if you're on an accrual basis, it doesn't matter. And if you're not sure, then you're probably cash basis, and make sure it's paid by end of year if you want the deduction. Same thing on the income side. You know, if you're busy this month and you're getting your receipts out, or you're getting your invoicing out, it's whenever you receive the cash. That's when you recognize the income if you're a cash basis taxpayer. So if you're taking off the last 2 weeks of the year, you might not have that many invoices to send out the last 2 weeks of the year. And that might be okay, because then you finish the work in January and you bill it in January, and you defer the tax on that for effectively a year and a half. So that's something to think about too. On the investments, so if there's any questions on ideas with expenses to accelerate, we get questions on make sure everything is current in your payables listing and your recurring items. Look at those and make sure there's not some vendors you could say, well, maybe we could use, and you don't have to account for inventory. We could use some more expenses in these items. Just little things that be simple to clean up here by 12/31 before the calendar turns. On the investment side, it depends on if you have a simple or a 401k or a SEP plan, simplified employee pension plan. I don't see those used as often as they should. It depends on where you're at in the tax brackets. You know, if you're in the 22% or under tax bracket, which is married filing jointly 170K or under, maybe you want to go Roth and do something different. Do before or after tax money. But you start getting, above 170K and into 300, 400, 600,000 and up, all of a sudden you're paying, 37% plus 5% Illinois rate, 42%. You may want to put back more in savings. If you're an individual, if you're an individual, you can set up a solo 401k, put even more than the 401k max, which is I think it's 19,500 for this year. The simple max is 13,500. So what we're doing with some clients that I'll just use a simple plan. They match up to 3%, and a couple of the owners are going to do the maximum match of the 13,500 as a year-end bonus. Well, why are they going to do that? Well, they're going to do that because it effectively reduces their taxable income by that amount from the business. The business gets a write-off of $27,000 in that case. For the bonuses for the wages paid. However, the taxpayers do not pick that up in their income tax. It doesn't show up on their box 1 of their W-2. So the business gets the write-off. It reduces their taxable income, and the client has put that money in their 401k, and it also didn't have any Illinois tax on it either. It didn't have the 5% hit there. That's something sometimes as a small business owner, you don't know how your year end is going to be. So maybe you're not sure if you're going to max out the retirement account or not. End of year, by then you know where you're at. So it's something that just to consider here at year end. But you want to make sure that's done on your last pay period, which is probably coming up here in the next, 2 weeks from today would be the 31st. So it need to be done by the 31st on that payroll. Now you get a little bit of wiggle room on a SEP. That's SEP, Simplified Employee Pension. And as long as that's paid by the tax return due date, you get a little longer time frame on that. But just think about your investment plan and talk about whoever works with you on your taxes to make sure you're okay there. Okay. Going into the future of the rates, there's been a lot of questions about capital gains. I don't know if anybody's been looking at this, but the idea that seems to be gaining the most momentum right now in Washington is where the top capital gains rate is lifted to an ordinary rate if your income is above 400,000. That for whatever reason, that's the number right now, is the 400,000. So if you're in that category, and let's say you're thinking of a like kind exchange deal, you've got some real estate properties or something on the side, you may decide maybe we want to just pay the capital gains rate at the 20% or the 23.8%, or the 15%, depending on what bracket you're in. There's 0, 15, 20%, which is about half of the top ordinary rate. Because if that happens, and down the road you're in a situation you have to pay taxes on the capital gains, there's a chance, I don't know what the chance is right now, maybe I'll just put it at, I don't know, 5 to 10%. I don't know. It's a risk though, that capital gains rates could be ordinary rates if your AGI is about 400,000. So just something to think about there. Then for the what was the other one? Oh, on the other one with the capital gains too, there's that reminder about the digital currencies and coins to make sure that you're reporting those as capital gains. Their IRS has been coming after some people there, so make sure you're reporting or noting that. IRS did a subpoena to some of the major tracking companies and have pulled a lot of individuals. So if you're involved in digital currencies, make sure that those find their way somewhere on your return, or you could be getting a pretty not so fun notice from the IRS. And we've seen some of those come up here in the Effingham, and we're up in the Coles County, and about a 60-mile radius from here. We've been seeing a few of those pop up. PPP, very important topic. We talked about it at the beginning of this. I want to make sure we cover it in decent detail here. Where this stands right now, IRS has released about 2 weeks ago. Even if you're not, if you think you're going to get the forgiveness, you anticipate it, even if you don't have the forgiveness, it is a 2020 item. It's effectively, even though the income isn't taxable, what it does is it reduces the wage expense you're allowed to take. So it effectively makes it taxable. So as you're doing your year-end planning, if you've got a PPP loan, even if it hasn't been forgiven, make sure if you believe it's going to be forgiven, you anticipate that it is, even if it doesn't happen until next year when you file that forgiveness, make sure you're including that in your tax planning. That could be, that could be the difference between 5 and 6 figures, even 7 figures, if you're not prepared for that. And that number times at that point pretty high tax brackets, probably a third of it, could be a rude awakening come April 15th when that tax bill's due, which will then increase your estimates on that first quarterly estimate for April 15th. So I just want to be clear, if you've got a debt or something on your balance sheet, get that moved over to your income statement. Make sure you're calculating that into your tax planning. Otherwise, you could be way off on your estimate of what you think is going to be due come April 15th. That's what I'd like to say. Does that make sense? Does anyone have any questions? Type them. I want to make sure that part's very clear. There was a bill that had some bipartisan support that contemplated not having that reduce the wages. As my understanding, though, is that likelihood is very slim that would pass. So I think from tax planning and year end, from your businesses and cash flow, to be prepared to have that be taxable and make sure those funds are set aside. That's the best information we have on that. And again, PPP2, with that coming up, maybe we'll get further guidance on how that might be worked, but be ready for that too in terms of applying, or if you know other business owners or leaders. We've had a lot of questions about this December, the COVID credits that are out there. This is the one that you can pay up to $511 per day for someone that's quarantined, or somebody that either they were quarantined by the local health department order, or they actually had COVID. As a business employer, it's under 500 employees, and you're not a hospital or nursing, someplace that provides health care. The employer is to reimburse or to pay up to 80 hours, 2 weeks, up to 80 hours of that pay. And then they can take that as a credit through 12/31. Right now we have a hard stop at 12/31. That credit of 100% is taken on the payroll tax return when you file the payroll tax return by January 31st. And you can ask for the refund at that point because you'll get that money back, or you can apply it and reduce your payroll tax payments, which could save you some dollars if you want to be doing that here the next couple of weeks. The other one is if you have a family caregiver, you pay them up to 80 hours, but at a 2/3 rate of their normal rate. And that's for any employees. The gross wage, their full amount. So there's been a lot of confusion with that, or people saying, yeah, that doesn't apply to me. And I think it was poorly worded initially, but it's been corrected since in the CARES Act and by IRS saying, no, you need to do this unless you're the hospital to provide this, but we're going to pay you back. So, well, we've done that. We had some of that in the third quarter. It kicked up in Effingham County, and they got the credits for it. They got their payroll taxes reduced, the refund checks. So it is a valid credit. It's a lot of dollars. And I'm seeing a question come in on the 80-hour COVID pay. The continue on PPP2. The question is if COVID pay will continue into 2021. As of now, it does not. And the ending date is here in 2 weeks. Now, what you probably want to do if you've had some employees that had the COVID and you didn't, or were quarantined and you paid them anyway, make sure you get that noted for your fourth quarter payroll tax return. It's not too late to take that, but make sure you get it done because as the question from Julie that came in, it stops December 31st as of now, unless PPP2 changes that. There's another question here on the PPP. Thank you for the questions. Love the questions. Recommendations to file the extension for 2020 taxes on the PPP deductibility. The PPP, even if you filed and you could always amend your return, but I'll tell you, amended returns go through. They're not the automated process, so sometimes people don't like to do amended returns because they just rather go through the e-file channels, and that's a different strategy altogether. If I thought that they were going to not have the PPP taxable is the reason you would do that, then I would extend. By the way, what we usually do on those if they have the large amount, we will extend the March 15th. S Corps will do March 15th. We'll extend those at least until April 15th, and by the time, and then see where it's at with the PPP or without. The issue then is, okay, what kind of estimate are you going to make? Are you just going to pay an extension payment based on the PPP deductibility? And to answer your question, yes, we are doing that with some clients that have that in there. Again, I don't think they're going to remove the PPP being taxable just because it seems like IRS is trying to prove a point with Congress, and that usually doesn't. When you mess with IRS, it just seems like it doesn't end well, or it ends up being I don't know. It seems being recorded, so I'll probably be careful. But it's IRS has a valid point where you don't get to take the expenses when expenses were paid with federal dollars. So I think it'd be a very difficult thing to get done, and I don't know how quickly they would operate to get it done. So but that said, we do have a couple of clients we are extending, or making a big extension payment on the basis that the PPP money is being taxed. So I hope that answers your question. There's nothing wrong with that strategy. I'm not going to recommend it across the board, though. I just don't. I would personally amend the return if it came out, but I don't know. I don't have a good feeling about that one. We had some. We get the U of I tax school updates too as well, and it's that one's not looking good. So anyway, that's where that stands though. Great question. And if you're not sure, you want to take the chance with it too. I mean, extend. There's nothing. The only reason I IRS, I like to ask different IRS agents when I'm on there what, different tips. And one time I've had recommended to me, if you never extend and all of a sudden you extend 1 year, that could be a trigger on your EIN. If you always extend, then I'm going to recommend the strategy that I think it was Blake that asked that question. Let's extend, put the payment in there and see what happens with it. If you've never extended before, that's just a question you're going to have to think about. Do I want all of a sudden to add an extension this year? 2020 is going to be an unusual filing year anyway, though. So I think the baselines or whatever IRS uses for random audit selections, just FYI, I'm sure will be odd anyway, just because of the year that it was. There's been a strange year. I don't have to tell any of you that. So that's so keep that in mind. One more thing to consider on the extensions. So my answer might change if I knew someone always extended to, yeah, this would be a good year to continue extending, and let's see if they do something different. Okay, and then the COVID. If anybody else has any questions on the COVID credit, the ending date. So I think we clarified that 12/31/20. And Norma, I'll plan to get you those updates if we see those extending, because any day or in the next week, we've had last few major tax updates have happened like the last week of the year. So I would not be surprised if we get some news here in about 7 days on something with this. And if you aren't getting those email updates from Norma on COVID and the tax items, please make sure you get signed up, and I'll make sure to get something to you as soon as we hear something on PPP2 and if it extends that 12/31 date on the wages, COVID wages. Okay. Make sure we've covered. We talked about the capital gains, the future of tax rates. This is just something I want to touch on. I'm going to open it up to Q&A. I don't think we're going to see rates lower than we are now. Illinois had the measure, the vote on trying to move to a progressive rates. And the graduate system, which full disclosure, I just opposed from a common sense standpoint, and throwing 15 new tax brackets at people, which is about what it would have added to whether you were single or married filing jointly, and it wasn't double. Marriage penalty was in there. The rates weren't put into what we were voting on. I don't need to go into all those things. What I needed to say is Illinois is going to be looking for some income somehow. And it could come in the form of, instead of 4.95% that we're being taxed now, to 5.95%. They've put that out there. Whatever it is, it's not going to go down from 4.95. Then on the federal level, the 7 brackets are being talked about going back to what they were and it'll add about 3% tax, an increase of 3% tax across the bracket. So that 0, 10, 12, I think the 10 still stays there, but the 12 turns to 15%. Which is a 25% increase in tax, 3% divided by 12%. So you got to keep that in mind. It becomes a bigger deal to say, wait a second, do I want low taxable income this year? Or may I just want to recognize some income, because next year or the year after's tax rates most likely have a very good chance of being higher. The other thing for small business owners on qualified business income deductions at 20%, there's talk on going after that one too. So that's been a really good deduction for business owners, that 20% pass through. But I don't know. That's just something to consider. I don't know that I would try to take the income too low in 2020 is what I'm getting at, bottom line. Okay, I want to open it up for questions now on strategies, equipment, things to buy near year end. Bonus depreciation is still good for this year. And by the way, bonus depreciation that's going to end here in a year, so we may not get that. We may go back to Section 179, a different write-off style, if you're familiar with that. But just to throw that out there, what questions does everybody have? Norma, you have any questions on or?
I do not.
What was that? Okay.
Maybe somebody else does.
The bonus right now, the 100% bonus depreciation. goes through December 31st of 2022. That's when it's set to expire. So we got another year, actually about 2 years on that. Julie, did you have a question? I just saw it.
See, what are 179 rules on new and used vehicles, and how does that change going forward?
Okay, right now we still get the section 179 on new and used. It used to have to be the new, same thing on the bonus. That goes, right now that remains unchanged. The max is $1 million write-off. It phases out at $2.5 million of equipment. So you could spend up to $2.5 million on equipment and write off $1 million immediately under 179 on the new or used. That number is also being talked about with the bonus depreciation and reducing how much people can write off. So right now we're good on the 179 for a while. So my strategy, what I've been recommending to clients is let's plan on using the bonus through the 2022. And then the section 179 depends on if you're in multiple states. I don't want to get too complicated because certain states have different depreciation add back rules. Let's just say we're in Illinois. We're only in Illinois and we got the federal state. I'm going to recommend just doing the bonus depreciation until 2022 and then switch over when that runs out to section 179. And as of now, section 179 seems to be, it's only gone up every year since I've been doing this last 20 years. I think it was like 25 grand or something when I started. So it's the fact that it's up to $1 million now. It seemed, and that's when, different administrations in the White House, different makeup of Congress, of course. It seems like that one's okay. It seems like the section 179, it's the bonus depreciation that I think has a more volatile future, if that helps answer your question on that one. So as of now, we're going to go with the 179 on the new or used. And that's still intact. Good question.
Any
questions
other?
on the investment? I was going to ask about on the investments or the retirement plans. Anything there? Otherwise, does I guess everyone's got Norma's information too. You can always ask her or something, especially if it's on this PPP or COVID or something you want to see covered. Norma and I catch up regularly, so if there's something you want to know about or see, I bet you do a good job of getting that down, and we can get that in that weekly. We're still going about weekly with that, aren't we, Norma? On the COVID and the PPP and other updates. I'm looking at my
Mm-hmm. You keep thinking one of these days you won't have to do that anymore, but
well, I think, yeah, we'll eventually get this stopped, but where it could impact some business owners are on the funding available and some of the damage that's been done. I mean, we've got a lot of businesses hurting in the area. So even if someone isn't specifically, it's still, I think it's good to get the word out so other people are aware of what's available to them. I mean, it seems like from the PPP funds that were utilized in Effingham, in the Mattoon area, were pretty good. There were still some that really probably could have used it that didn't get any, and either just didn't know about it or didn't want it. I don't know. I mean, it is a lot of money and it impacts the U.S. deficit. So I understand there's philosophical reasons there too. Could be. Okay.
Anything else?
So, as long as everybody is ready and knows what approximate brackets they're in and whether they're ready for April 15th, that's the big thing.
Yes, that is the big thing.
Yeah. Just don't get blindsided. Be proactive. Any IRS notice you get, IRS notices are on the rise, by the way, and they've notified that there is. Biden mentioned putting about $5.1 billion into the IRS enforcement program and take it back to a lot of the IRS audits that were going on in the mid-90s. So that's why I mentioned the record keeping organization. I should have said that earlier. So just be ready. Know where you're at. That said, there's a lot of gray areas in the tax law and places in IRS code where it contradicts itself. Definition of wages is defined differently inside of the Internal Revenue Code, depending on what you're talking about. So just your best offense is a good faith effort in keeping your documentation and be ready for the tax season. Looks like did one more question come in there, Norma? Okay.
A lot of Covet Pay going out in all of 2020, but even more so in the last quarter. How concerned should I be with the documentation as to whether employees qualify for 10 days of Covet Pay?
The Covet Pay, the employee is in. If you have, I would print out. I don't know if you have an email, even a text. I would print it out and throw it in their HR file, especially if you have a big number, because it has a higher likelihood of getting looked at. The requirement is that they're under a federal, state, or local quarantine order, or they've been advised by a healthcare provider, or they've even been having symptoms and seeking it. So you can't really say, well, you got to get a doctor's note. No, if they're seeking the diagnosis and the employee says, I am sick, to my knowledge, there's nothing else with that you can do in that case. I mean, if a negative test isn't going to help, I guess if they get a negative test, you can ask for that. Say, please give me whatever test results you have. You got to keep that confidential, HIPAA reasons. But the bigger dollar amount that you're requesting for the COVID credit would dictate the good faith effort in getting whatever you can, emails, texts, document the phone call with the employee that they were seeking the medical diagnosis, had the symptoms, or that that they're representing to you, that the health department said they have to stay home for 2 weeks, and then just sign it and date it. And that's about all you're probably going to get in the file on that. Yeah, good question. Good question. That's what we've done. We've had a couple people out, and we just put the notice on with the HR file with what was one of the ones we do some of the payroll processing here, and we just note it in the file with what it was while we're taking it. And I mean, you can't. I don't think you can call out an employee for making it up, but you just can document what they represented to you. But put something in the file. Put something in the HR file to get it. Good question. Okay. Well, if anything else comes up, please let Norma know, and we'll get back with you.
All right. Well, thank you so much, Matt. Thanks for joining us for the webinar and some good questions that were asked. It's very knowing how to do all this stuff. We're glad we have local accountants that are have to keep track of it for us. So thank you, Matt. So this webinar is been recorded, and it will be available tomorrow through our business advocate email newsletter. And so you be sure and get that if you want it. If you want it emailed directly to you, just let us know, and we'll be happy to do that. So looking ahead to 2021, we are going to, as I mentioned earlier, we're going to continue the virtual webinar series. It's going to have a name. It's not just going to be the webinar. It's going to be called HYPE, which is Heighten Your Professional Edge. And we'll have a whole topic list here for you very soon. But you'll be able to buy the whole series if you want, or individually. In January, we do have our program set up. I didn't look at the date. It's the third Thursday in January. It's again going to be on finances, and the presenter will be Julie Everett. Julie is a certified financial planner here in Effingham, and so she'll be talking about other aspects of finances that will be important to know looking at the new year. So again, thanks for joining us. Have a wonderful day. Have a very Merry Christmas, wonderful New Year. We'll talk again soon. Thank you.
Thank you.